Hello and welcome to our new investment strategy update. The global economy has turned a new page, with the Federal Reserve finally cutting interest rates. Could the Fed pull a soft landing? That would be quite a success. US rates are falling in an economy that is normalizing after 4 disrupted years. Inflation is close to target, unemployment remains low, and growth should stay healthy through 2025, although it is slowing. Recession looks unlikely, and a soft landing remains therefore in sight. Corporate earnings are still rising, and the labor markets are showing little signs of stress. Following the first large cut, the Fed has plenty of room to cut rates further to cushion growth before they reach a cruising level, one that neither stimulates nor stalls the economy. This so-called neutral rate could be around 3.5%, and depending on the November election outcome, we may get to that level around mid-2025. In fact, monetary easing should continue across most developed economies as inflation gradually falls. The Fed's move has also given central banks in other regions more room for maneuver. That now includes China's central bank as well, as the country launched a coordinated stimulus package in late September. Yes, the Chinese economy still faces long-term challenges, but authorities have taken back the initiative. Overall, the global rate-cutting cycle is in full swing, and global growth now looks to be settling around long-term levels. Of course, plenty of risks threaten destabilization, from conflicts in the Middle East or Ukraine to the inflationary impact of new tariffs and the tighter labor markets if Republicans win November's US elections. But for now, the effects of these risks on the global economy seem contained, with growth holding up. Let's hear from Nanette about the investment risks and opportunities we see in this environment.
A new era for central banks also means a fresh path ahead for investors. Our expectation of a soft landing guides our investment strategy. Easing monetary policy and low recession risks should continue to support risk assets. Yet, we also see reasons to tread carefully. Global growth is slowing, geopolitical risks are elevated, and investors are facing a US presidential election unlike any other. After a strong run year to date, equity markets look more vulnerable to corrections. So how are we positioning our clients' portfolios? There are reasons to be optimistic. Rising earnings and solid margins should support stocks in the months ahead. But there are also reasons for caution. Earnings expectations are no longer being revised higher, and company valuations are full. Of course, rate cuts should support both equities and fixed income. A return to more typical asset class correlations means bonds are playing a valuable diversification role in portfolios again. We therefore adopt a balanced global strategy when managing portfolios, and we stay close to our strategic asset allocations to equities, bonds, and commodities, including gold. Within equities, we seek value in regions where performance has lagged to date. As growth slows, equity market concentration has fallen and market leadership has changed. In response, we have narrowed our sector preferences to materials and energy. In fixed income, we prefer German bonds and UK gilts over US treasuries, hedging these investments against the portfolio's reference currency. While we expect some short-term volatility, the long-term appeal of these investments remains solid. In credit, spreads over government bonds remain relatively tight, particularly in the US. Here, European corporate bonds offer better relative value. In currencies, the start of the Fed's easing cycle and the market's high expectations of future cuts mean we now adopt a neutral stance on the dollar. Instead, we prefer currencies where central banks have limited appetite for more monetary easing, such as the Swiss franc and the Japanese yen. Meanwhile, the euro and the pound sterling could struggle to gain ground. Of course, market developments will also bring new opportunities, and we stay alert to these as we equip our portfolios for changing times. There are quite a few key events on the horizon, including a hard-fought US election that could shift the dynamics for risk assets. Thank you for watching.